Gold has been acting very strange. It's been smashing through all-time highs, recently crossing $4,600 an ounce, but the usual reasons the experts give you just don't add up anymore. The old rules, the ones that governed gold for generations, seem to be breaking down right before our eyes. What if I told you there are powerful hidden forces at play that the charts and the mainstream financial news just aren't showing you? That this isn't just another bull market, but a fundamental rewriting of the 5,000-year-old rules of money. In this video, we're going to expose the real story behind gold's explosive moves. We're not going to look at simple trend lines. We're going to look at flight logs. We're not going to talk about just inflation. We're going to talk about fear. We're pulling back the curtain on a massive, almost covert buying spree by the world's most powerful financial institutions, central banks, and uncovering a quiet global bet being placed against the very foundation of our financial system. This isn't just a story about a yellow metal. It's a story about power, about debt, and about a loss of faith that is silently reshaping the world economy. The mainstream story tells you gold is rising because of interest rate expectations or geopolitical tensions, and while that's part of the picture, it's like describing a hurricane as a bit of wind and rain. The truth is far more structural and far more profound. The world is drowning in an unprecedented ocean of debt. Global public debt has soared past $100 trillion. When you include all debt, household, corporate, and government, that number balloons to over $251 trillion. This number is so vast, it's almost meaningless, but its consequences are very real. It means that the money in your bank account, your pension, your entire financial future is tied to a system that has promised more than it can ever possibly pay back. And the people in charge know it. That's the secret. Stay with me, because what they are doing about it is the real story, and it's the one that the charts will never tell you. To really get how strange gold is acting, you first have to understand how it's supposed to act. For decades, the relationship was simple, almost like a machine. It was a dance with one main partner: real interest rates. Real interest rates are just what you earn on a safe investment, like a government bond, after you subtract inflation. When real rates are high, holding gold is expensive. Why own a rock that pays you nothing when you can own a bond that offers a nice inflation-adjusted return? So gold prices tend to fall. But when real rates are low or negative, your safe government bonds are actually losing you money. In that world, gold becomes super attractive as a way to store your wealth, and its price tends to rise. This was the iron law of gold. It was dependable. It was predictable. Until now.
Over the last couple of years, and especially in 2025, that law got shattered. We've been in a period of high interest rates as central banks, led by the U.S. Fed, fought to get inflation under control. According to the old rulebook, gold should have been in the doghouse. It should have been one of the worst performing assets. Instead, it went on one of the most ferocious rallies in a generation, gaining over 60% in 2025 alone and setting over 50 new all-time highs. It didn't just ignore high real rates, it openly defied them. This is what analysts are calling the Great Decoupling, a fancy term for the old rulebook just got thrown out the window. Gold has untethered itself from its traditional anchor. The financial models used by thousands of analysts on Wall Street, the ones that fill financial news and are debated endlessly on TV, simply broke. They failed to explain what was happening because they were based on a world that might not exist anymore. So what replaced the old rules? The answer is a new kind of buyer. A buyer who doesn't care about interest rates, a buyer who doesn't care about opportunity cost, a buyer who isn't investing for a financial return, but for strategic survival. This is the price inelastic buyer. Price inelastic sounds a bit clinical, but it stands for a very dramatic idea. It means you will buy something no matter what it costs. Think of a diabetic buying insulin. They don't haggle, they don't wait for a sale, they buy it because they have to. In the world of gold, two major forces have started acting just like this. First, as we'll get into, are the world's central banks. They aren't buying gold because they think it will hit $5,000 an ounce. They're buying gold because they are terrified of the alternative, holding all their country's savings in the currency of a geopolitical rival drowning in its own debt. For them, gold isn't an investment, it's insurance, and you don't quibble over the premium when you think the house might burn down. Second are retail buyers, especially in the East. For hundreds of millions of people in places like China, they're watching their main store of wealth, real estate, go through a historic collapse. They can't easily access global stock markets, and they don't trust their own. So they're turning to the one asset that has preserved wealth for millennia, an asset that sits outside their government's control. Just like the central banks, they're buying for preservation, not speculation. Their demand is becoming price inelastic because their fear is bigger than their financial calculus. This is the key to the whole mystery. Gold is no longer being valued just against the interest rate on a U.S. Treasury bond. It's now being valued against a much bigger, unquantifiable risk, the risk of the whole system failing. The risk that the currencies we use, the bonds we hold, and the systems we trust just aren't as safe as we thought. The old charts show you gold versus yields. The new reality is gold versus fear, and you can't plot fear on a Bloomberg terminal. This decoupling isn't a temporary glitch. It's a signal of a massive shift in what the world considers money and what it considers safe.
For most of the 90s and 2000s, central banks were gold's biggest enemies. They were net sellers, constantly dumping hundreds of tons on the market every year. The thinking back then, pushed by Western economists, was that gold was a barbarous relic, a dead asset with no place in a modern financial system. But then, after the 2008 financial crisis, something changed. The selling slowed, then it stopped, and then it violently reversed. The last few years have seen the biggest and most sustained period of central bank gold buying in recorded history. They've gone from being the biggest sellers to, by a long shot, the biggest buyers. But this isn't just a simple portfolio adjustment. This is a quiet revolution, a deliberate and strategic withdrawal from the U.S. dollar-based financial system. This is de-dollarization in action. For decades, the world ran on the dollar. Nations held U.S. Treasury bonds as their primary savings because they were seen as the safest asset on earth, backed by the full faith and credit of the United States. This gave America an exorbitant privilege. It could print its own currency to pay for things, and it could use the dollar system as a weapon, imposing sanctions that could cripple its enemies' economies. But after the 2008 financial crisis, and especially after the freezing of Russia's dollar reserves in 2022, a chilling realization swept through the non-Western world. Their savings weren't truly theirs. They were held on a platform controlled by a foreign power, and access could be cut off at any moment. The dollar went from being a neutral, reliable asset to a potential weapon. The reaction was immediate and dramatic. Central banks, led by China, Russia, Turkey, India, and even countries in the EU like Poland, began a frantic and sustained buying spree of physical gold. Crucially, they weren't just buying gold, they were bringing it home, moving bullion they already owned from vaults in London and New York back to their own countries. They wanted their insurance policy in their own house. The numbers are staggering. In recent years, central banks have consistently bought hundreds of tons annually, with some estimates suggesting they will average nearly 190 tons per quarter in 2026. This relentless buying continued even as prices soared, confirming their price inelastic behavior. This isn't a market timing game, it is a strategic necessity. The goal is to reduce their dependence on the U.S. dollar, whose share of global reserves has fallen to a multi-decade low. They are swapping paper promises from a debtor nation for a hard asset with no counterparty risk. Gold is no one's liability. It cannot be frozen or devalued by a foreign power. It is the only truly neutral reserve asset on the planet. But this story isn't just about governments. A parallel movement is happening on the ground, particularly in the East. In China, a gold fever has taken hold. Middle-class families are lining up to buy gold beans, bracelets, and small bars. This has exploded not because they're speculating, but because they're terrified. The Chinese real estate market, the main savings vehicle for a generation, is in a historic collapse. People have seen their life savings vanish. Their trust in the government's economic management is shattered.
For them, gold is an escape hatch. It's a private, tangible asset that can be held outside the state-controlled banking system. It's a way to protect what wealth they have left. This is not investment demand as we understand it in the West. This is survival demand. And it's not just China. In India, a country with a deep cultural love for gold, demand is also a response to economic uncertainty and the desire for a store of value independent of government policy. Even here in the West, a quieter trend is underway. High net worth individuals and family offices, the so-called smart money, have been steadily increasing their allocation to physical bullion. They aren't buying paper gold ETFs, which have their own risks. They are buying the real thing and putting it in private vaults. They see the same writing on the wall as the central banks: unsustainable debt, political instability, and the slow erosion of our money's purchasing power. They're making the same calculation as the People's Bank of China, just for their own family. These three groups, the de-dollarizing central banks, the fearful Eastern consumer, and the quiet Western billionaire, are the new engine of gold demand. Their motives aren't about yield or quarterly returns. Their motivation is about preserving wealth in an increasingly shaky system. They are the hidden force, the price-inelastic buyers who are rewriting the rules of the gold market. Before we go any deeper into where this is all heading, I need to pause for a second. What we are witnessing is not a simple market trend. It is a massive shift in global power and finance. It's a hidden financial war being waged not with armies, but with balance sheets. Central banks are quietly walking away from a system that has governed the world for 50 years. Entire populations are losing faith in the money their governments print. The rules of money are changing under our feet, and the mainstream media is still looking at the old playbook. If you want to understand these deeper currents, if you want to connect the dots that Wall Street and the financial news networks ignore, then you need to be here. Hit that subscribe button and join a community that is committed to looking behind the curtain. We break down the uncomfortable truths about debt, currency, and power, because in the years ahead, understanding this system will be the most valuable asset you own. Subscribe now, because what's coming next is going to affect every single one of us. So why now? Why are central banks and regular people all making this massive coordinated move into gold at this exact moment? The answer is the single biggest and simplest economic story in the world today: the mountain of unpayable debt. As we mentioned, total global debt has surged past $250 trillion. Let's try to put that in perspective. Government debt alone now stands at over $111 trillion. The United States government, which issues the world's reserve currency, is adding nearly $2 trillion to its own debt pile every single year. This isn't a problem that can be solved. It's a condition that has to be managed. Think of it like this. If you have a credit card bill you can't possibly pay, you have a few options. You could work more hours to earn more money, the growth option. You could cut all your spending to the bone, the austerity option. Or you could just declare bankruptcy, the default option. Governments face the exact same choices. Can they grow their way out? No. Global growth is slowing, not speeding up. There's no magical economic boom on the horizon big enough to even make a dent in this. Can they use austerity? No. That means huge cuts to social programs, pensions, and government services. In a democracy, that's political suicide. In an autocracy, it leads to a revolution. No government will choose this path willingly. Can they default? A default by a major economy, especially the United States, is unthinkable. It would trigger the instantaneous collapse of the entire global financial system. Every bond would be worthless. Every bank would be insolvent. It would be an economic apocalypse. So if you can't grow your way out, can't cut your way out, and can't default your way out, what's the only option left? There is a fourth option, the secret hidden option governments have used for centuries. You don't default on the debt, you default on the currency.
You pay the debt back, but you pay it back with money that is worth a whole lot less than when you borrowed it. This is called currency debasement, and it is the inevitable endgame. How do they do it? They simply print money. Central banks create new currency out of thin air and use it to buy government bonds, funding government spending and paying off old debt. This flood of new money erodes the purchasing power of every dollar, euro, or yen already in existence. It is a slow, quiet, and often invisible tax on everyone who saves. It is a wealth transfer from savers to debtors, and the biggest debtor of all is the government. This is the global bet against the system. The central banks buying gold, the Chinese citizens buying gold, the wealthy families buying gold, they are all making the exact same bet. They are betting that governments will, because they must, choose the path of debasing the currency. In this light, gold's true role becomes crystal clear. It is not just an inflation hedge. Inflation is just a symptom. Gold is a debasement insurance policy. It is an asset that cannot be printed. Its value isn't based on the promise of any politician or central banker. While the denominator, the dollar, the euro, the yen, is being systematically destroyed, gold simply holds its value, as it has done through the fall of every empire and the collapse of every paper currency for 5,000 years. This is why its price is decoupling from real interest rates. The market is slowly waking up to the fact that the risk-free rate on a U.S. Treasury bond is no longer risk-free. There's no real return if the money you get paid back with is worthless. The real risk is not that the U.S. government won't pay you back. The real risk is that what they pay you back with won't buy anything. So when you see gold rising, don't think of it as a commodity going up. Think of it as the value of our paper money going down. The price of gold isn't the story. The story is the dawning global realization that the post-1971 paper money experiment is in its final chapter. Now, with all that said, let's be real for a second. No asset moves in a straight line, and the path to $5,000 gold, a target now cited by major banks like JP Morgan and HSBC, is full of risks. Blindly piling into gold at all-time highs just because of the hype is a dangerous game. The biggest short-term risk is that this whole narrative is wrong, or at least too early. What if the global economy is more resilient than we think? What if a new wave of tech innovation creates a productivity boom? What if the U.S. actually pulls off a soft landing, taming inflation without a deep recession? If that happens, the Fed could keep rates high, the dollar could get stronger, and the old rules of finance could snap right back into place. That could trigger a sharp, painful drop in the gold price, maybe 15 to 20%, wiping out all the recent speculators. There's also a paradox hidden in the central bank buying itself. It's a concept called demand destruction. As the price of gold goes up, central banks need to buy fewer tons to hit their strategic goals. For instance, if a bank wants 15% of its reserves in gold, it needs to buy twice as many tons at $2,300 an ounce as it does at $4,600 an ounce to get to the same dollar value. This means the very rally they're helping to create could contain the seeds of its own slowdown. As the price climbs, their physical demand in tons could naturally fall, pulling a key support out from under the market. That's a negative feedback loop very few people are talking about. Finally, the explosion in interest through paper instruments like ETFs, while pushing the price up, also makes the market fragile. ETF investors are often chasing momentum and short-term trends, not long-term conviction. If the price were to turn south, a stampede for the exits from these paper holders could create a cascade of selling, making any downturn much worse. But these are risks along the path, not a change in the final destination. The ultimate revelation is this. The strange behavior of gold is the market slowly and painfully pricing in a new reality. Gold is no longer just another asset within the financial system. For a growing and powerful group of the world's most important players, it is now being treated as an asset outside the system. Its value is becoming a direct reflection of the level of distrust in that system. The charts don't tell you this because you cannot chart trust. You cannot draw a trend line for faith. You can't put a moving average on geopolitical stability. The real story behind gold's rise is that for the first time in generations, the world is seriously thinking about a future where the US dollar is not the center of the financial universe, and where government promises are not the ultimate safe asset. This is a monumental, once-in-a-century shift, and gold is simply the messenger. So gold is acting strange because the world is acting strange. The financial system we've lived with our entire lives is showing deep cracks, and the people with the most to lose are quietly looking for an exit. This explosive rally is not a fluke, it is a symptom. It's a symptom of a de-dollarization movement led by powerful central banks. It's a symptom of panic among hundreds of millions of citizens in the East who no longer trust their economies. And most importantly, it's a symptom of a global financial system straining under the crushing weight of an unpayable mountain of debt. The charts will show you support levels and resistance lines. They'll offer you price targets and fancy indicators, but they will miss the entire story. The real story is a slow-motion currency crisis playing out on a global scale. The real story is a vote of no confidence in the future of paper money. Whether gold pulls back to $4,400 or charges ahead towards the $5,000 forecasts from major banks like JP Morgan, Goldman Sachs, and HSBC depends on the day-to-day chaos of geopolitics and central bank decisions. But the underlying forces, the debt, the debasement, and the deep-seated distrust are not going away. They are accelerating. Your job as an investor and as a citizen is not to guess the price of gold next week. It is to understand what its price is telling you about the health of the system itself. The question is no longer if our financial system will be reset, but how and on whose terms. Gold's price isn't a prediction, it's a real-time report card on that reset. To keep ahead of this story and to continue exploring the forces that are reshaping our world, make sure you are subscribed. The rules of money have already changed. Don't be the last to find out. Thanks for watching.